The US stock market has entered a low margin for error phase. Once a macro shock triggers a repricing, the semiconductor sector will be the one that gets hit the hardest. The S&P 500 keeps climbing, but beneath the surface, the level of fragmentation among individual stocks has reached its highest since 2015. What is the VIX? It's the market's fear gauge, specifically designed to measure expected volatility in the broad market over the next month. Right now, it's sitting around 17. The lower the number, the less the market expects anything major to go wrong. But here's what I'm telling you today. The calm you're seeing is an illusion. The real problem isn't at the index level, it's at the individual stock level. After cross-checking several indicators, my conclusion is clear. The degree of internal fragmentation in this market has surged to its highest since 2015. The last time we saw this kind of split was during the pandemic crash in March 2020 and the tariff tantrum in April 2025. Meta, a tech giant, is trading near its 52-week lows. Micron and AMD have more than doubled over the same period. All tech stocks, all in the same sector. One is on the floor, the other is through the roof. There's a specific term for this in finance: dispersion. It means the gap between winners and losers has stretched to an extreme. Some stocks are skyrocketing, others are collapsing. The two cancel each other out, and what you get is an index that looks perfectly calm, as if nothing is happening at all. The index looks calm, but risk is piling up at the individual stock level. A handful of mega cap giants are carrying the index higher, while the majority of stocks are already struggling underwater. Microsoft and Meta, for example. This extreme dispersion is masking an increasingly dangerous structure. Let me introduce the first indicator, the S&P 500 Dispersion Index. It measures the differences in volatility among S&P 500 constituents. Think of volatility as how wildly a stock swings. The higher this index, the more stocks are moving independently of each other. Right now, this index is lower only than two periods: the pandemic crash in March 2020 and the tariff tantrum in April 2025. In other words, aside from those two major crises, this is the most fragmented the market has ever been. Now the second indicator, VIXEQ. It doesn't look at the broad market, it looks at the implied volatility of individual stocks. What is implied volatility? It's the price the options market assigns to a stock's expected future swings. The greater the expected turbulence, the higher this number climbs. VIXEQ is currently at 46, a historical high. 17 versus 46. The options market on the broad index looks perfectly calm, but at the individual stock level, it's wound up to the extreme. Investors aren't worried about the S&P 500 crashing. They're frantically hedging against the risk of individual stocks. They've bought insurance on single names all the way up to historic highs. The spread between VIX and VIXEQ is the widest it's been since 2015. This is a structural tear. The VIX is telling you everything is normal. VIXEQ is telling you the undercurrents are violent. The enormous gap between these two numbers is the market's most honest warning signal. Now the third indicator, the 3-month implied correlation index. It's fallen below 10. This index ranges from 0 to 100. Above 50 is considered high. It means stocks are tightly grouped, rising together and falling together. Below 20 is considered low. It means they're all moving independently. And below 10 is an extreme low, signaling that fragmentation has reached an extreme. When correlations are this low, the market structure is extremely fragile. In the current market, capital is hyper-concentrated in a small handful of stocks. Everyone's holdings are different. Everyone's buying their own thing. And this every man for himself structure is heavily dependent on one thing: nothing going wrong. The moment the macro environment suddenly shifts, the problem begins. The shock itself is only the fuse. What really accelerates the selling is the chain of dominoes that the shock triggers. Leveraged ETFs breach their thresholds and are forced to liquidate. Quantitative funds see moving averages break and their algorithms automatically sell. Options market makers scrambling to hedge their exposure are forced to dump the underlying shares. None of this selling has anything to do with fundamentals. It's purely the mechanics of the market executing their commands. And since capital was already concentrated in just a handful of names, when these mechanical sell orders slam into the market all at once, the fragmented every man for himself structure collapses instantly. Everyone's first instinct is to reduce exposure. From everyone buying their own thing, it turns into a collective rush for the exits. A synchronized sell-off erupts. That is the entire process of a rapid risk repricing. The last time the implied correlation index fell below 10 was the summer of 2024. What happened next? The Bank of Japan unexpectedly raised rates. The yen surged. The global carry trade unwound all at once. What's a carry trade? Simply put, it's borrowing cheap money to buy expensive assets. At the time, enormous amounts of capital were borrowing yen at zero interest rates, converting it into dollars, and piling into US stocks and chip stocks. The moment the BOJ hiked, the yen strengthened, borrowing costs rose, and everyone in that carry trade was forced to sell their US stocks at the same time, convert back into yen, and repay their debts. Semiconductor stocks led the collapse. From extreme fragmentation to total synchronization, it took only a few days. The summer of 2024 was the carry trade. Right now, it's AI and semiconductors. The structure is exactly the same. Capital is hyper-concentrated in a small number of trades. Everyone's positions are fragmented, seemingly uncorrelated on the surface. Once a macro shock triggers those chain reactions, correlations will spike from 10 to 80 in the blink of an eye, going from every man for himself to a full-blown synchronized sell-off. A market that looks calm on the surface is often completely shattered by a single shock when its structure is at its most fragile. If this scenario plays out again, the sector with the highest implied volatility, semiconductors, will inevitably take the most brutal beating. Micron and AMD will be the first two to get slammed. Micron and AMD have both more than doubled since late March. Expectations are priced to perfection. Valuations are stretched. The options market is packed with speculative positions. What are options? They're leveraged tools for betting on whether a stock will rise or fall. When stocks go up, they amplify your gains. When they fall, they amplify your losses. These same characteristics that fueled the rally will serve as an accelerant on the way down. The SIBO Semiconductor ETF Volatility Index is now more than triple that of the S&P 500. Triple. In the same market environment, under the same macro shock, the semiconductor sector will swing 3 times as violently as the S&P 500. At this point, I want to go one layer deeper. Is this extreme dispersion and low correlation purely a natural market phenomenon? Or is it possible that this is a carefully maintained setup? Think about it. When the broad market VIX is pinned at 17, but individual stock volatility has surged to 46, who has the strongest incentive to preserve this surface level calm? It's the people who need to hand off their chips to someone else at elevated prices. As long as the index doesn't fall, retail investors won't panic. As long as the VIX stays low, the media won't scream about a crash. Everything looks like it's still on track, and you can calmly distribute those stocks that have tripled or quintupled, slowly offloading them onto the next buyer. This isn't some conspiracy theory. This is the foundational logic of the market. The last thing big money wants when they're distributing is to trigger panic. The moment the VIX spikes, liquidity evaporates instantly, and no one can get out. What is a liquidity freeze? It's when you want to sell and suddenly discover there are no buyers left. The price just keeps getting hammered lower. So the ideal distribution environment is exactly this. The index is stable, individual stocks are rotating, and the retail investor watches their own stocks decline, but looks at the broad market and thinks everything's fine. They don't cut losses. They hold on. They might even add to their position. And the shares you're holding on to are precisely the ones the smart money wanted to sell you. Those semiconductor stocks that have gone parabolic. AMD doubled, Micron doubled. Who's been buying? Retail investors, ETFs, passive flows. Who's been selling? Go check the insider transaction data. Go look at the shifts in institutional holdings. The louder the bullish consensus, the more seductive the price chart, the more reluctant retail investors are to walk away. That is the perfect moment to exit. This kind of extreme structural tear has never, in history, been a midpoint in a bull market. It either resolves through individual stocks falling or through the index falling. Right now, the probability of the latter is rising because the core belief that has driven this entire rally, that AI capex will grow without limit, is being questioned by more and more voices. The moment those expectations begin to reset, the valuation of the semiconductor sector will go from reasonable to expensive, and from expensive to bubble. As for the catalyst, it could come from any direction. The Bank of Japan moving rates again, the Fed turning unexpectedly hawkish, a geopolitical escalation, or even just a single disappointing AI chip order. In a fragile structure with correlations this low, a wind blowing from any direction can bring the entire house of cards down. The US stock market has entered a low margin for error phase. Once the fuse is lit, the ones that fall the hardest will inevitably be the ones that rose the most. The US stock market has entered a low margin for error era. What this phase demands is managing your position size, keeping ample cash on hand, and waiting for opportunity. After watching this episode, go take a look at your portfolio. If it's stuff with high valuation growth stocks, ask yourself this. If something like the summer of 2024 happens again, how long can you hold on? Thanks for watching. Leave your thoughts in the comments. I'll see you there. Cut through the noise and see the real picture. If you're vibing with this content, smash that like button and subscribe. See you in the next one.